begin, and she will present on a paper, Costs of Climate Change. Dr. Garcia Appendini is a senior research fellow at the Department of Banking and Finance of the University of Zurich. Her main research fields are corporate finance and financial intermediation, with a special focus on financial distress and trade credit. Next, we will hear from Dr. Abraham Louie, who will present a paper called Shelter from the Storm, Which Safe Asset for Climate Disasters? Dr. Louie is a professor of finance at UDHEC Business School, co-director of Scientific Beta Research Chair. He specializes in asset pricing theory in general, with a specific focus on factor investing and ESG and market equilibrium more recently. Next, we will hear from Dr. Ping Wei, who will present the paper, How Does VIX Response to Nature Disasters? A Cross-Country Perspective. Dr. Wei is at the Business School in Central South University, Changsha, China. Finally, we will hear from Dr. Nora Pankratz, who will present the paper, Labor Market Frictions and Adaptation to Climate Change. Dr. Pankratz holds a PhD in finance and is a postdoctoral researcher at the UCLA Luskin School of Public Affairs, working on financial economics of climate change and adaptation investment. So now it's my great pleasure to turn it over to Dr. Garcia Appendini. Thank you.
Hi, sorry, I think it's a technical error, but may we invite Dr. Garcia Appendini to turn on your camera and your mic on, please?
Yes, I had them. Okay, I was already speaking, sorry. Okay, so let me restart then. So thank you very much to the conference organizers for accepting this paper to the conference. And this is joint work together with Claudia Custodio and Adrian Lam at Imperial College in London, and Miguel Ferreira, who is at Nova School of Business and Economics. And so I guess I don't need to convince anybody in the audience that global temperature is likely to increase by at least 2 degrees Celsius over the next decades. And actually, we are already starting to witness how an increase in temperature is associated with disruptive weather events. So I don't know if you are seeing my screen. I don't think you were, but okay, so here's my. Okay, so the question that we are addressing in this paper is, how do changes in temperature affect firm value? And when we talk about firm value, in particular, we're going to focus on the revenues, firm revenues. And we are going to focus on the impact of temperature on the supply side. So how much do these disruptive weather events affect firms' ability to supply goods? Now, when we try to empirically address this question, we face an important challenge, which is that temperature changes do not only affect the ability of firms to supply, but it also affects the demand side, the demand for products. So in order to address this issue, we are going to base our research on a methodology that is pretty much established, especially in the banking literature, but also in the corporate finance literature, which is basically to fix the demand side. And the way we keep the demand side fixed is that we compare the changes in sales of suppliers of the same client in the same year. So the client is purchasing, has a fixed demand, and we're going to compare the changes in sales across the different suppliers of this client. And the idea is that different suppliers are going to be located in different locations, so they're going to be differently exposed to changes in the temperature. And because temperature is exogenous to an individual firm's activities and individual suppliers' activities, then we can actually estimate the effect of how temperature affects supply. So let me just motivate with a little drawing. So this is, let's assume that we have one client who buys from 3 different suppliers. At time t, it buys different amounts. At times t+1, it buys, again, different amounts from each of them. And let's assume that there's a hot wave, for example, a heat wave that affects supplier 3 at time t+1. So what we're going to do is we're going to compare the sales of supplier 3 from T to T plus 1 with respect to sales of supplier 1 from T to T plus 1 and from sales of supplier 2. Okay, empirically, what we're doing is basically running a regression where the dependent variable is the sales, the log of sales of supplier I to client J at time T on the changes in the temperature in the supplier's location and with fixed effect at the client and time level. So I will certainly not have time to go to the detail in our results, so let me just summarize them here. So what we find basically is that a 1 degree Celsius increase in the average yearly temperature can lead to up to a 2% decrease in supplier revenues. And of course, extreme heat and extreme cold events, which are defined as events that have a negative impact on property or even on human life, have a much larger impact. But we find that actually there is a lot of heterogeneity across different types of firms. So temperature is more disruptive in firms that belong to industries that are more sensitive to heat, such as construction, where you just cannot turn on the AC. And also on labor-intensive firms that require a lot of human capital. So, so this suggests that this ability of firms to supply is disrupted because of a productivity channel. And we also find that smaller firms are more disrupted by temperature, and also firms that sell more standardized goods, such as commodities, are more disrupted due to temperature, presumably because the clients can switch to a different supplier that is not disrupted. And a new result that we are starting to explore now is that actually a temperature, this reductions in the revenues of the firms can also lead to real effects, in the sense that if the firms that are affected by temperature are also financially constrained, they may reduce their investment in capital expenditure. Okay, so let me very quickly mention the data. So for firm level data, we use Compustat segment. So all public firms in the US are required to disclose the name and the amount of sales to the most important clients. So we collect that information, which is yearly from years 2000 to 2015. And we have very granular data on weather from the PRISM climate group. We have daily temperature and precipitation for a 4x4 kilometer grid for all the continental US. So we aggregate this data at the county level and at the year level by taking the averages, and we match this to the headquarters, to the location of the firms by the county and the fiscal year end. And we have around 5 suppliers per client and year in order to base our estimations. So this is our baseline result. So when we run our regression on all the firms in our sample, we find that on average, a 1 degree increase in temperature, depending on the specification, is going to lead up to a 1.9% reduction in firm sales. As I mentioned before, extreme heat events can lead to up to an 8% reduction in sales, and extreme cold event can lead to an up to 36% reduction in sales. Let me very quickly summarize what we find regarding the economic mechanisms. So we find that the results are much stronger for labor-intense firms. So when we compare what happens for a 1 degree Celsius increase in temperature for firms that have an average value of employees to assets, we see that the result is at minus 2.2% decrease in sales. But if this firm has a 1 standard deviation higher ratio of employee to assets, then the reduction in sales is going to be at minus 4.5%. And also we find that the effects are driven by heat-sensitive industries. We also find that larger firms are able to mitigate the effects of temperature on sales. So if firms are larger, firms that are 1 standard deviation larger than average, the effect on sales of 1 degree higher temperature is minus 3%, whereas if they're 1 standard deviation smaller than average, it's going to be minus 3.9%. So there's a lot of variation. And again, switching costs, if a firm sells standardized goods, the effect of 1 degree Celsius increase in temperature is minus 3.6 reduction in sales. Very briefly, I just mentioned that since we find that weather shocks can affect firms' revenues, and there's a large literature that shows that investment can be sensitive to firms' revenues or cash flows if firms are financially constrained, then we explore whether these weather shocks might cause real effects. So for this, we examine firm-level investment. So we switch from the supplier client level of data to the firm level data, and we analyze what happens to investment. So here the dependent variable is the investment in capital expenditures, and we find that for the average firm in the sample, there is no effect of changes in temperature on investment, but firms that are constrained have a significant reduction in their capital expenditures. So let me conclude, because I think my time is up. So what we do in this paper is we identify the effects of climate change on supplier sales, controlling for the unobserved changes in demand. And we find that the costs of climate change are economically meaningful, starting with a baseline result of minus 1.9%, and it can be as high as minus 36% almost for extreme cold events. And we find that climate change can lead to lower investment for financially constrained firms, which is a very interesting result, especially in the light of the post-COVID world, where we see an increase in the debt level of many, many firms. So our main contribution is to disentangle supply from demand effects. But let me stop here because my time has ended. I want to thank you very much for your attention.
Thank you so much. I'll now turn it over to Dr. Abraham Louie. I'm afraid, excuse me, I'm afraid that we cannot hear you, Dr. Louie. We can not hear you.
And no?
Oh, yes, now we can hear you. Thank you.
So I should start from the beginning, right?
Okay. Yes, please.
Okay, sure. Okay, sorry. So this is a joint paper with Matthew and Mark. They are both former PhD students at EDHEC. So just the paper in a nutshell, in case you want to, I don't have time to finish the slides. So the idea is to try to convince you that GAFAM can help with climate disasters in a way that was not so obvious before ourselves. We looked into these papers. So the idea of the paper is the following one. In general, in periods of stress, we do observe a flight to safety, where people look for some safe assets, widely documented worldwide, where the typical safe asset is the US debt. And the question is, what happened during extreme weather events, like hurricanes, okay, which we consider to be a particularly stressful event. And there we show that high-tech stocks do feature a safety premium of around 7% on a yearly basis. Okay, so the roadmap to try to convince you is the following one. Let me start first by do climate disasters matter? It may seem obvious today and quite a trivial question, but when you look at the global risk landscape from 2006, the extreme weather events were not exactly something that the world was caring about that much relative to other sources of risk, like, for example, terrorist attacks. Even in 2010, after the financial crisis, if you look at this figure, for example, extreme weather events were here in the middle. Okay, but since 2019 and now 2020, extreme climate change and extreme weather events are on the top of the global risk, both in terms of likelihood and of impact. And when you look at the hurricanes, which are the events to which we are going to devote this paper, you can see that the hurricanes can have substantial impact both economically and humanly in terms of death. So in terms of damage, the damage can be as high as 133 billions, which is quite high. And unfortunately, also in terms of death, you can reach numbers as 3,000. So of course, the natural question is whether hurricane episodes can be treated as flight to safety episodes. Well, flight to safety episodes in general are characterized by two main features. The first feature is a large volatility relative to the normal times. And the second one is a huge underperformance of the stock market. When you look at the realized volatility of stocks collected into industry portfolio, you observe a clear tendency of stocks realized volatility during hurricane episodes to increase. Okay, so in these figures, you have 10 days after hurricane made landfall, the realized volatility, as well as 30 days. On the x-axis, you have the estimation window, and the y-axis, you have the realized volatility during the event window. There you see that the volatility during the event window, which is when hurricane happen, is on average much higher than during the estimation period. So as far as volatility is concerned, no question, there is more volatility. In a previous paper of us, we have shown that standard factor pricings, factors that price assets like size, value, etc., are strongly hit during hurricanes. Okay, and the market in general also experiences a very substantial underperformance. That is, it loses money around -1% in 1 month, which is quite a huge. If you bear in mind that the average return of the market, the average excess return, may be around 0.5, 0.7%. So losing 1% in 1 month when an hurricane hit is a lot of. So no question, it is a flight to safety episode. A lot of volatility, and equity markets just underperform. A huge advantage of hurricanes relative to many papers that have been published on flight to safety, even two recent ones in Journal of Finance, is that all the academic papers, they know that there is a flight to safety only ex post. Why? Because they base their identification on, for example, the VIX. When the VIX hits a high level, they say we are in a flight to safety. That's not at all the case for hurricane, because the hurricane season is known ex ante. You know that from June 1st to November 30, it will be the hurricane season. So this is what is beautiful in this natural experiment of hurricanes. It is a flight to safety, as I showed you, with volatility and underperformance, and also it's exogenously identified as a flight to safety episode. Now, during a flight to safety, people are looking for safe assets, okay? So safe assets, obviously, beyond some low credit risk, it's something that people are willing to pay a safety premium for it. And the prototypical safe asset is the US debt. Okay, here you have the evolution of the debt in the US relative to the GDP, so just huge. And here you have the holding of foreign people of US debt in their foreign holding. And for a while, people were thinking that US bonds are just the prototypical safe assets. However, recently, many papers try to question this by showing that the market is factoring that current debt is a danger for the future. And you see it in the swaps, where we don't see that much premia for the treasury relative to corporate bonds in the swap market. Okay, better than this, we ask the question, fine for foreigners about the US bonds, but what about US customers? Okay, what about US households? Which safe asset I will be looking for? So this is what we try to do in this paper, to try to identify a safe asset. I will explain in a moment how we do it. So the way we do it is we group the stocks into industry portfolios, and then we look at the abnormal return of industry portfolios during hurricane periods. Okay, then we identify portfolios and their abnormal return. Just to give you a sense, for example, here you have the abnormal return of the portfolio. It's on a daily basis, okay, in percentage, okay, and this is the cumulative portfolio abnormal return up to 2 days after landfall to 30 days. And what you can see is that three industry emerge are performing pretty well during hurricane episode, which are high tech, banks, and gold. And gold, they outperform like crazy. However, when you have a statistical eye, you see that while the performance of gold is quite high, the T-stat is not that high, which means that together with a high performance, they experience also quite high volatility and probably quite higher moments like skewness and kurtosis. And this is very dangerous to base a decision only on the abnormal return. As a side contribution of our paper is to question all the event studies focusing just on abnormal return. We suggest to move to higher moments in event studies. We take into account event studies. How? Instead of using abnormal return, we convert the abnormal returns into what we call in financial theory certainty equivalent. Think of it as a convenience yield, okay, as a certain return which is equivalent to the uncertain return delivered by the industry portfolio. And as you can see, there are not that much sectors which deliver a positive convenience yield, apart energy and high tech. Okay, energy and high tech have the highest convenience yield. Okay, and this is quite robust, whether you control for quality or even for the VX. So, just to conclude, what we try to show this paper is that high tech stocks in general, not only GAFAM, emerge as safe assets, and the way we show that they are safe assets is by showing that people are willing to pay a safety premium of around 7% on a yearly basis, 1% 1 month after hurricane made landfall. So this paper contribution is also to show that risky assets can become safe assets. And also I hope that this finding can help you understand what's going on right now, where we see 3 or 4 high-tech companies are just capturing 40% of the S&P 500 market capitalization. Thank you very much for your attention.
Dr. Wei, you can start sharing your screen right now.
Hello, can you hear me?
Yes, we can.
Okay, so hello everyone, I'm Ping Wei from Central South University. So I'm going to share screen with you guys. Sorry, it's the end. So good morning, I'm Ping Wei from Central South University. I'm delighted to present you today my recent work on natural disasters. It is a paper written together with Xiaodan, Yunfeng, Li Hui, and Professor Chen. So my presentation today will cover 5 parts of the paper. So firstly, I start with the motivation of the paper. It has been well recognized that the increase in the frequency and the severity of natural disaster since the 1970s has caused significant impacts on economic development. So figure 1 indicates economic losses from natural disaster worldwide. So in spite of this fact, sorry, can you hear me? I just double check because I can't see any other screen. Okay, I just continue, shall I? So research attention on how and to what extent financial markets are sensitive to climate risk and natural disasters is only very recent. Existing research has already focused on how the natural disaster impact on sovereign debt, on credit supply of commercial banks, on international financial flows, on stock markets, and more recently, on pricing of properties and corporate cash holding. However, many of those empirical results are very mixed. So those studies have helped us understand the relationship between fragility of financial markets and disasters. And also help us understanding how disaster risk relate with market efficiency, relate with market liquidity, market risk premium, and market volatilities. And to summarize, historic and realized volatility have become primary focuses of existing analysis. So more recently, a forward-looking perspective has been called in both academic and policy field, for example, in G20 Green Finance Study Group, and also from a recent report by NGFS. So in a forward-looking perspective, it has been emphasized that both near-term and long-term time horizon shall be applied when assessing future risk. It will help to identify the future, the opportunities, and also improve awareness for potential long-term risk. And it is in this context we want to propose to use market volatility index as a way to bring a forward-looking perspective into research on future expected volatility and natural disasters. So what is VX? It has been well known as implied volatility and the investor fear gauge. It is developed by the CBOE since 1993, and it calculates expected future market volatility over the next 30 candidates by using the listed option prices. And it is believed VX contains both informational and sentimental components. In many recent studies, VX has been used as a market systematic risk proxy. And also, it is believed VX is informational better than historical or realized volatility in terms of it contains more information, it reflects more the investor sentiment well, and its predictability improves over time. But however, studies on impact of disaster on VX are still very limited and underexplored. Our second motivation is relevant to cross-country studies. So far, there are still very limited cross-country studies, but in the literature, it has already been pointed out the impact of disaster on economic growth is actually diversified at a national level. So risk by natural disaster are equally concentrated between the firms, sectors, and countries in terms of geographic dimension, and they are also differ by institutional setting. So this is why our key question for this paper is actually quite simple. We're trying to assess the response of expected volatility to natural disaster in a cross-country perspective. So in order to address this question, we have collected more than 1,000 natural disasters from between 1990 to 2018, and VX data from 13 countries. We are using the event study methodology and the ARMA-GACH model and GACH-MEDIAS model. Generally speaking, so one of the most important in our paper is we are concerned with both the long and short effect of disasters on financial market volatility. And we also focus on differentiated impacts across countries, investigating both geographic and institutional dimensions of impacts. We have two main findings. So the first finding is what we find is occurrence of natural disasters increase market volatility by 7.64%. And it is most significant for geophysical and meteorological disasters. And impact of the natural disaster on VX is only a very short-term effect. So secondly, what we find is sensitivity is affected by the level of financial market development and the vulnerability of natural disaster in a country. It is surprisingly actually we found out that the countries with developed financial markets and low exposure of natural disaster are more likely to increase market volatility. And no matter how vulnerable their natural disasters are, the response of VIX in countries with underdeveloped financial markets to natural disasters is generally not significant. So to summarize our contribution, we wish to contribute to the empirical debate on understanding the financial markets in pricing climate risk. We also wish to contribute to a better understanding of cross-country variation. And finally, we wish to contribute to climate risk management among multinational capital investors and financial regulators. So next is our hypothesis, research design, and the results. So due to time limit, I will go through very quickly about this part. So if you are interested in our finding, please refer to our papers in the website. So we have three major hypotheses. So the first one is built on the existing literature. Occurrence of natural disaster will lead to the rise of VIX. The second is natural disaster have certain effects on the fluctuation of VIX but do not have a long-term effect. And finally, we have hypothesis relevant to geographic and institutional dimension of impact. Here are our data sample. For natural disaster data, we use the EMDAT database. We also divide our natural disaster data into four broad groups, which is climatic disaster, geophysical, hydrological, and meteorological disaster. So by doing so, we assume that each type of disasters have a very similar level of probability distribution of a potential occurrence. Our market volatility data is available from investing.com. So we have a daily VIX from the 13 countries. We also have other economic and financial data from World Risk Report and World Bank. Our sample period is from Earth date available, which is 1990s to 2018. For the model, we have two modeling strategies. So firstly, we use the Arma-Scotch model to estimate cross-country response of a VIX to natural disaster. So in this formula, DISAS is the most important indicator which represents the occurrence of a natural disaster. We use the Gauge-Medes method to decompose VIX to long and short-term volatility components to estimate long and short-run effects of a natural disaster on VIX. So again, due to time limits, I will not go to the technology, the details. So here are the main findings. For univariate analysis, we find a significant response on VIX to the outbreak of the natural disaster. And we also run the regression results by full sample and by each country. So here are one of our most important findings. We find the occurrence of natural disasters will increase market volatility, effective volatilities by 7.64%, and it is most significant in Korea, Germany, and United States. So we also run our regression results by natural disaster types. We run the regression to estimate the geographic dimension and the institutional dimension of impacts. And we also track the interaction impact between the geographic and institutional factor. And finally, we have the results trying to understand the long and short-run effects of a natural disaster on VIX. We also run results not just covering the whole country and also covering the different each countries and by geographic institution dimension and also by different type of disaster risk. And finally, our robustness tests include the modeling check and also test different type of the sample selections. So generally speaking, our regression results point in the same direction as before, indicating our results are robust. So to summarize our research, so we wish our finding can provide an empirical basis for investors who use DX to risk alert and hedging for cross-country natural disaster risk. And also, our results show so far that the countries with higher level financial market pay more attention to physical risk caused by environment such as natural disaster risk. So these findings are very consistent with some many recent findings, particularly on stock market, such as by Hudson Home last year. So that's all. So thank you so much for your listening. So I'm going to stop my sharing. And also camera off.
Thank you. Turn it over to Dr. Nora Pankratz. So I invite you to turn on your camera and audio. Thank you.